August 22nd, 2023. I want to start off by saying that tomorrow morning, if, I don't know what the gap's going to look like, but if we have a fairly neutral gap, we start to get bull bars and we're starting to head towards this low, I would be very careful about being long. There are a lot of trap traders below bar 69, bulls who bought below 69, expecting that they're going to be able to buy more lower and get out. Now, a lot of traders will exit below 70, but a lot of traders will be willing to scale in lower and even below the low of the day, which you can see is where we reversed up. But if we start to get here and maybe to this close, I would start to be really careful about being long because this is, well, because this is a bear spike and generally the top of bear climax is a resistance area. And where trap traders are also resistance and support areas. That's kind of how you find those spots. So I would be careful about being long around this low tomorrow or that high. If you are long from somewhere in here, any sort of reversal up down here could potentially lead to a vacuum test of these lows. So if you do, if we do have a fairly neutral gap and get a reversal up, I think this is the correct profit target or this to just get out of your trade. And we got an interesting measured move today we got a surprise on bar 60 and follow through on 61. And you can see 59, 60, and 61, 3 straight bull bars. And we got a measure move up. And we went one tick away from it on bar 70. And spikes generally lead to measured moves. In trading ranges, they can be a little disappointing, but I'm going to go over that when I get to that at the end of the review. But, something to consider is that this is a spike, and so it will also probably get a measured move. So, tomorrow or whenever we end up hitting this measured move target up, or down, either or, you don't have to look for it. I'm probably not going to pay too much attention to it. But in general, I think if we go up here or the next time we get down here, there'll probably be support or resistance. We also got a leg one, leg two measure move today, early in the day. It's easier to see if I do this. Bar one high to the bar three low. You can see that was leg one. And then became leg two to bar seven. And it was a perfect leg one, leg two. The pullback being when it pulled back above bar three. And I wanted to essentially go over one more thing before I start. And that is the concept that I reviewed of channel line overshoots, where you had this bear channel line and, there's so many numbers, bar counters. This big channel line and the market overshot the channel line here. And when it overshoots, there's a 75% chance that the market is going to reverse because I went over that anyways. But when you get an overshoot, there's 75% chance the market's going to reverse. And so here you have this channel line, and then you got the overshoot as the gap. The gap was the overshoot. And so 75% chance we're going to get at least a couple hours of sideways trading today. Okay, so bar one, bear bar closing near flow. We're on its midpoint. That we're probably going to end up getting a couple hours of sideways trading today. Bar two, follow through. The initial profit target for the bears is the 75 high because it's yesterday's high, and bulls want to keep the gap open with yesterday's high. Bears want to close the gap with yesterday's high because it's a sign of weakness for the bulls. You can see on bar three, we are able to close that gap. Something interesting is some bulls will buy below bar one, hoping the gap stays open. And those bulls who bought, you can see they bought more, maybe 5 points lower, maybe 5 or 6 points lower. And on bar four, you can see those traders were let out at one tick past their break even. So if you bought this low, you probably disappointed in two, you bought more 5 points lower, you were able to get out at break even. And kind of the same thing, if you bought below three, exactly the same thing. If you bought below three and you bought more 5 points lower, you can see you got filled on seven, and then you got out towards the top of seven. And so that limit order bulls are making money. So this looks like a breakout phase, and it could be a breakout phase, but it's more likely a tight bear channel because limit order bulls are able to make money. And if limit order bulls are able to make money, that probably limits how strong bears are going to be. And so you just have to be wary of that. And while it was a bear day, and it did close relatively near its low. If you just look at the daily chart, you'll just see, it starts at its top, closes near its low. It looks super bearish. It wasn't as strong of a day as it could have been. Bar four, double top with bar two, a potential swing short, but I don't think I want to take that sell. It's probably too sideways. We might get to the moving average though. And you get follow through on 5 and 6. So 5 follow through, but tail on the bottom. It's sell to close. And it's definitely always in short. We were always in short on the close of bar two. but I don't know how much lower we're going to go here. Follow through on 6, and then a reversal up on 7. I wouldn't buy above 7. It's the first bull bar, and although it's a two-legged correction, and this is seen as, for the bulls, as just a giant bull bar. So it's a bull bar, two-legged pullback. The pullback is a pretty tight channel, so buying above 7, looking for a retest maybe is the best idea. 8, bear bar closing near its low. Potential second leg from 4, 5, and 6. So essentially creating 3 pushes down. 9, big bull bar. Didn't let 8 trigger, but 8 wasn't a very good short. Probably sellers above 8 if we get above it, which we did on 9. Bar 10, bull bar, but closing around its midpoint. It's an inside bar, but not closing very well. So probably sellers above the high, probably buyers below the low. Then you get bar 11. Bar 11 is interesting. It's a huge bar, so the risk is huge. So a lot of traders don't want to take it. And if you do sell bar 11, what do you want to see? Think about it. You're selling the bottom of a tight trading range. So it's low probability. So if you're going to take a low probability trade, you want bar 11 to be huge. You want huge follow through on bar 11, on bar 12. You want huge follow through similar to bar 13, but you don't get it. On bar 12, you can actually see that any bull who bought below 10 bought more, was disappointed in 11, maybe bought a little more lower. And when the bears got bad follow through, it let those traders out. So you have less trapped bulls on bar 10. And then you get bar 11. Sorry, I'm very tired. You have less trapped bulls from buying below bar 10 and lets them out during 12. And so it's less likely that something like this is going to happen. And when something like this does happen, you can see there's a tail on the bottom. Bears saw this as a gift. Any bear who is short anywhere in here knows we're probably getting back to this breakout point. And this breakout point, since bulls are probably going to buy, below these bars and buy lower and expect to get out at break even. Since limit order bulls, they made money here, they made money here. They're expecting to make money here as well. So bears will start to buy back shorts at the close of 13, causing bar 14. Sellers above 14, because it's a low probability swing. It's 3 pushes down. You could argue that, but this is strong enough for a second leg, and that might be 15. You can see we touched exactly the low close on 13. So any bear who sells 13, disappointed 14, gets out around break even on 15. And that's pretty common in trading ranges. In trading ranges, you pretty much have to expect disappointment. And when you get a surprise, the surprise usually causes disappointment. But if you get a surprise, sometimes you can get a swing trade. 16, I don't know how to describe how this is not a great buy above 16. Sometimes you're going to get a bear bar here. Occasionally you'll get a bounce, but the problem with the bounce is a lot of times when you get this, now what? If you're buying 16, bars like 17 aren't uncommon, but when they happen, you really usually don't get good follow through because this is so steep. And this is, 10 to 13 or 11 to 13 is pretty strong. And so it's unlikely that we're just going to go straight up. We're probably going to have to pull back. Since we're going to have to pull back, a lot of traders know that. And so if buying above 17, you have to have a wide stop. And a lot of traders don't want to risk that much, knowing that we're probably not going here. And even if we do, we're going to pull back a lot along the way. So that's why you don't get many buyers above 17. That's why you get a bad follow through bar on 18. And so that's what I was getting at was if you're buying above 16, you're pretty much hoping for a bar like 17. But the problem is a lot of traders scalp out when you get 17. And I'm not sure the trader's equation is all that great. So it is a double bottom, but this is just really steep. Is I guess the point I was trying to get across. And it makes me not want to take the buy above 16. It also, you're buying the top of a tight trading range. 14, 15, and 16 is a tight trading range. And you're buying, there's a breakout point right here, right where those bulls who bought. Think about if you bought below bar 7 or you bought below bar 12. How are you feeling when you see 13? You're probably pretty disappointed and you're just hoping to get out a break even. And so if you buy above 16, you're buying right where other bulls are selling. Do you really want to be buying where other bull traders are selling? I know I don't. So 19, bear bar closing, slight kind of near its low. It's maybe an okay swing short. It's probably, you probably have a 40% chance of getting a measure move down, something like this, which is, where we ended up going. So this is part of that 40% of the time, right? But if you sell below 19, put a stop above here and put a limit order down here and just walk away for an hour or two, you get filled. So you probably have about a 40% chance of getting this measure move down. Hard to hold short through all this though. Follow through on 20. The follow through on 20 is pretty ideal. If you sold 19, you probably wanted to see 20, but you have to keep in mind that 14 through 18 was a bull micro channel. And it was two legs up, yes, but 16, 17, 18 was probably strong enough to get a second leg. So you got to be careful. 21 trades above 20 and then trades back below it. And so it's two legs down. 19 and 20 is the first leg, and then 21 above below is the second leg. And so if you get 22, bar 22 closing on its high, a lot of traders will buy, seeing that we've had a lot of buying pressure today, and they're hoping we at least get back up to the 10 close and potentially higher. But 22 doesn't close on its high. Disappointing bulls, which is common in trading range days. And then the follow through 23 is not very good, as to be expected. Probably just vacuum tests of around the 18 high. 24 is a double top, maybe a reasonable swing short. I kind of equate it, it's like 19, but you're selling lower. You're selling more towards the middle of a trading range than the top of it. So I don't really love it. So no surprise, you get bad follow through 25, and then you get a good bear bar on 26. And this whole thing was a triangle, essentially like, spike, spike, and then channel and trading range. And so the apex of the triangle is always a magnet later in the day, which is where we reached. 26 is a reasonable swing short. I think you can sell below it looking for, a measured move down, maybe a 2-to-1 of bar 26. I know we didn't quite get there on, oh, yes, we did. Never mind. I personally, though, would take profits on 33 at the close of 33. I'll explain why in a second, though. 27, follow through, yes, but not the best follow through. If you're selling 26, you probably want a better breakout bar, but it's two bear bars closing near their lows. So it's probably enough to just, enough to stay short. 28, if 28 triggers, you might have to get out, or maybe you could get out a measured move above 28, something like this. Or, like 2 points, basically, like, I don't know, 2 points above 28 or a measured move above 28. But, sometimes 28 will get a pretty good bounce. So I would be getting out above it or a measured move above it. And it is also the bottom of a trading range, triple bottom, potential wedge. So really not the best to stay short below or when 28 forms. 29, bear bar, breaking to a new low. Bulls who buy below 28 are probably going to make money. And you can see they tried to on 30 and 31. We got 29, disappointing follow through 30, but we weren't quite able to get back to that low on 31. And so you potentially have some bulls trapped in, which is good news for the bears. But limit order bulls, have limit order bulls been successfully trapped a single time today? No. So, well, in theory, it's good that you have trap bulls. You also know that those traders are probably going to make money. You get 32, triggering the low one short below 31. And then you get big follow through on 33. And this is the best looking bar in this entire thing. It's a big bear bar, small tails, closing near its low. It's really big size. And when you get the best bear bar, this deep in the trend, you also have to keep in mind, we had a pretty steep, obviously we had a steep breakout, and then it becomes, a channel. And so when you're at the bottom of the channel, and so it's just really not all that great. I think, by the way, it also turns into a trading range. And so, trend lines get less steep as the market evolves into a trading range. And that we might have to get back to the 28 low, and this is really climactic. And the 2-to-1 measured move of bar 26 is right here. And so it's only 1 or 2 points away. And so your stop has to be up here, and you're only like 2 points of profit, and you're risking like 7 or 8 points. It's not a very good trader's equation. So a lot of traders just exit the market. And that's one of the reasons we ended up getting the reversal. We ended up triggering that and getting down here. But a lot of times you'll just get an inside bar. And then, sometimes it can get really big towards the breakout point of 32, which, we're probably going to get back to this low since bulls buy below. We probably might have to get back to this low as well. 34 is an interesting bar. It's consecutive sell climaxes. You have this, and then you have a two-legged correction. You have this, and then it flips to always in long. So flips to always in long. You have more complex correction. And then essentially you have like this. This was a more rough drawing. You can look at it as, 3 pushes up. So you have 3 sell climaxes down to this. So consecutive sell climaxes, you're at the bottom of a channel line. and you're just right after a sell climax where bears are going to take profits. And some bears will stay short below 33, taking a chance we collapse, but we don't collapse on 34. So a lot of bears buying back shorts above 34. Doji bar on 35 and then big bull bar on 36. But now if you're buying, the risk is big because you're hoping we get up here. What are the odds we get up here before we pull back? Not very high. And 35 is kind of a problem for the bulls because it's bull spike, trading range, bull spike. And so we're probably going to have to test the 35 high because bears sold above it. 35 to 37, you can see we were not able to test that. And then we got a big bull surprise on 38. But, we might have to get back here. There's essentially a magnet around the 33 close and the 35 high. So I'm not that convinced that we're just going to race straight up without going back and touching the 35 close first. We might have to go a little higher. We might have to test that 28 low, maybe the apex of the triangle, but it's reasonable to think we're going to get back here. And kind of the same thing when we get 30, 38, 39. We have an open gap with the 37 high and the 40 low once we see this low 1 trigger, or I guess low 2 trigger below. Sorry, my voice today. Below 39. And then we get bar 40. And so bad follow through on 41, and sellers above. And it's 3 pushes up and a wedge. And so a lot of traders just start to take profits knowing that we're probably going to close this gap and probably going to close this gap. Bar 41 is disappointing. I mean, what are the odds? Think about when you see this. How often does the market just keep going up this steeply, like all the way up here? Almost never. I guess, yesterday, but generally that doesn't happen. And yesterday's reversal was a pretty different context. The open had a lot of strong bull bars yesterday, so that makes it more reasonable to expect a reversal up versus not a lot of strong bull bars here. Some here, but we're already kind of testing that area, so it's not as good. 42 bear bar closing near its low, bulls exit below, maybe bear sell. Big bear bar 43, yes, but we're just closing gaps. It's a trading range day. Trading range days, the pullbacks are going to be deeper than you want them to be. For example, theoretically sell the close 13, deep pullback. Here, theoretically buy the close 61, deep pullback. Here, huge pullback all the way down to essentially where traders would get stopped out. And the problem with being long up here is that you have to have your stop down here. And when your stop's down here, if it gets hit, you're probably going to find buyers right where you're selling. So it's not ideal. 44, potential bear trap, but not closing near its high. If it did close near its high, it's probably a reasonable buy, hoping we at least get back up to the 41 low. For the same reason that, we were probably going to test the 35 high, and we were probably going to test the 37 high. There are trap bulls below 41, and bulls have been making money all day, buying below 1, buying below 3, buying below these breakout points. Bulls could have pretty much bought below pretty much anything today, and they're making money. So that leads you to believe when you're buying below a bull bar like 41, yeah, you're trapped for right now, but those traders are probably going to make money. And you can see on bar 62, we went right back to that low on 41, and that's where we sold off aggressively because everyone started to agree it was going to go there, and then we sold off. 44, low 1 short, but you're at the bottom of the trading range, not that good. You can see if you did sell 41, you're probably disappointed in the fact that we failed to break below the 34 low immediately. Or sorry, 45, you're disappointed we failed to break below the 34 low immediately. So those traders exit around break even after the 46 close, causing buying on 47. Probably sellers above 46, but we could get kind of a deep correction. So I wouldn't sell above 46. 48 is a double bottom. Maybe an okay buy looking to get to the 41 low, but it never triggers on 49. Disappointing bulls. Remember, disappointment is common in trading ranges. Then you get bar 50, low 2, but not that good. We're probably still going to end up being more sideways here. Bad follow through 51, 52. 50 is a double top at the bottom of a trading range, so I wouldn't take that short. 54, bull bar closing near its high. We're probably going to test 53. And bad follow through for 54 on 55 because it's right after 4 straight bear bars, and you don't really want to buy after 4 straight bear bars. Which is another problem with this, by the way, is that you had 61 or 62, 63, 64, 65 preceding it. You had this, true, but this is also kind of an issue. And so maybe you can buy above 66, but you got to be a little careful because this is pretty strong. And traders who sell above 62 are probably going to make money. which they do on 70. So you just have to be careful about that if you're getting long anywhere up here. We might have to test the 62 high. $56, maybe okay to buy, looking for the 41 low, but you probably should have a stop below the low of the day because it might pull back here. You are buying the top of the tight trading range. 57, outside down, but probably buyers below. And if we go down any lower, buyers below there too. And you can see bad follow through 58 and 59. It's essentially a like two-legged correction. Down, up, down, and then up on 59. But 59, if it closed stronger, I think it's an okay buy, but it doesn't. Follow through 60. You can see once we started to get above here, everyone kind of agreed we were going to the 41 low, and that's why you get these big bars and follow through. But once we get there, it turns into a second leg trap. And that's pretty common. Like if you bought up here, like I said, deep pullback, bulls who bought, most of them should take profits when you see 62 and just anywhere around this low. Any bull who decided to hold, taking a chance that we just race right through the 41 low, not a good idea, but some will do it. But if you do, when you see 62, you just need to dump your longs, which is exactly what happened, caused 63. Probably not sellers below 63 because big up, big down, probably sideways. It's a trading range day, so expect disappointment for the bears here. 64, bad follow through for 63. 65, inside bar, but again, probably buyers below, probably sellers above. And you get a big bull surprise on 66. You have to keep in mind we might have to test the 65 high since there are probably sellers above. We are lower in a trading range, so it's a little less likely, but it's still reasonable to sell above 65 and scale in. So you have to be careful of that. So some bulls buy above 66 hoping we get good follow through, and they're not disappointed. We get good follow through on 67, 68, and 69, small tails on 67 and 68, and then a big climactic bar on 69. It's the best looking bar out of all of these, but it's really, I personally would probably end up staying long. If I bought 66, I personally would probably stay long through 69 and exit below 70. Better traders than me might exit on 69 or exit at least a piece above 41, citing that it was just a vacuum test of the 41 high. But I'm not good enough to be doing that yet. And then you get 70, big bear bar closing near its low. Follow through on 71. Bulls who are long are selling out below 70, causing 71. You get follow through 72. Not excellent, but still follow through. And then after 3 straight bear bars, bulls know it's definitely always in short. It was probably always in short below 70. But sometimes you get 2 bear bars and then another reversal. But 72 is a big problem for the bulls, and the remainder of bulls sell out and give up, causing 73, 74. And, bulls are giving up. And right as the final bulls are giving up, we run the weak stops of bulls who had stops here, who bought somewhere up here. And those traders get stopped out right before it reverses. So that's why you don't want to have a stop down here. If you're buying up here, it's better to just get out below 70. Always in. Definitely always in short below 2. Stop above 1. I don't think it reversed to always in anywhere in here, or always in long anywhere in here. That 7 is, probably a minor reversal, and where it's unlikely we're getting up here, or even really up here. Once you get probably bar 11, you can have a stop above 11. Big follow through. Probably briefly became always in long on 17, but right as it becomes always in long in trading range days, it reverses. So you got to be, a little bit worried if you're buying 17, probably stop below, and you just exit below 19 most likely. Definitely back to always in short below 20, stop above 18. Maybe you could have a wider stop above here until this trades below. And once it trades below here, your stop can be here. Basically, once it breaks out, your stop can be above the prior low, higher low. That's how you trade trends. An easier example, 63 breaks out. So let's say you buy the close of like 57. Your stop's below 54. You get a breakout on 63. Your stop goes below 60. Couple legs down. Probably still always in short all the way through here. Bullet bears exit here. Briefly becomes always in long on maybe 38. But climactic, probably always in short below 42. Definitely by 43, obviously. But as it becomes clearly always in short, it starts to go sideways per usual. See, always in short, clear, sideways, always in short, clear, sideways, always in short, clear, sideways. Always in long on 60 with a wide stop. I don't know if the always in flips below 63. Maybe it does. It's a big bar, and you can definitely make an argument for it, but you kind of got to be careful with how strong this is. It's not, I really don't think we're going to collapse here. But we did test the magnet that wanted to be tested. So probably back to always in short below 63, and then immediately always in long above 66, stop below 64 maybe, and then maybe even a wider stop. If always in short on 63, stop above 62, and selling below 70. Definitely bulls and bears sign below 70, so always in short below 70, stop above 70. 34 was a reasonable buy. I thought 26 was a reasonable sell. Yeah, not great for stop order traders. Limit order traders, I kind of talk about them throughout the day, or throughout the review, but I guess probably buyers somewhere down here, probably buyers below this. I'm going to be spending more time trying to, think of limit order trades because they're really hard to think about, and that's kind of the whole important thing of the market. This is an expanding triangle too, technically. 1, 2, 3, 4, 5. Kind of interesting. But yeah, on the daily chart, low one short. It's not very good after these bull bars. I'm probably going to go more sideways here. Low probability of just a crash tomorrow, or just a big sell-off closing down near this low or past it. Most likely sideways and disappointing. And yeah, that's pretty much the day.